Good morning. It's Friday, and it is the first session of It's Your Estate, and we'll be with you for the next 5 weeks after this. And go ahead, Pete, say something. Your mouth is open.
I've lost my picture, so here we go. Sign in.
Oh, that's good. Pete's going away for a moment here. So what I'm going to do in the interim while we're doing this is I'm going to share my screen again. And what I'm going to do is share this. And so this is the website. And so, Pete, you're still visible to me. So I think you're still working it. Okay. So anyway, we're in. So one of the things we wanted to let you know is the material that you'll see today, recordings are all here. And when I had said before, here's the website. This is the information where you can actually go to see those. And the easiest way to know, whoop, Pete just went away. The easiest way for you to get in here is www.itsyourmoneyestate.org. And that will bring you in here. And if you click on workshops, there you go. I can come down here to It's Your Estate. Hello again, Pete.
Hello.
Come down to It's Your Estate. And under these, you'll see, for instance, here's the webinar. Here's the handout material that I'm going to go through today. My Ask First form is there, a blank one. And also there's a workbook, and I'll mention that in just a couple of moments. But it allows you to go through and get all the material. You can go look at other ones. And at the bottom of this section, there are various articles that Pete has put in here to look at. And you simply can go week by week, click on what's coming up next. And that material, as it gets posted, will be available to you, and you can see those. So all of that is available and where we're going through it. So let me stop. Did you want anything else on the website, Pete?
One of the things is but we're going to go through your Ask First form.
We will go through it. We're not going to go through it here.
And we're going to point something out as to that on the website is a blank Ask First,
which
form.
I just said, yes, while you were transitioning through.
Yes, thank you.
So, okay. Let me do this. Let me switch gears and go to this one. So let me do a bit of an introduction here for us. Where did that guy go? I don't want this. That goes away. Okay. So this is similar to what we had talked about in the beginning, but now that we're recording, I want to go through this again. So it's the first week of It's Your Estate. I'll come back to my Ask First form in a minute, but what I want to touch on is this is an overview. And Pete, yes, I will come back to the Ask First form, but today is an overview, and we're going to talk about tax and estate law changes. Next week, very important to you, is healthcare and power of attorney. What we want to look at is where are you going and what are you doing in terms of when something happens to you, which I'll point out to you in a moment. Third week is wills and trusts. Fourth week is retirement planning. Fifth week is charitable contributions. And the last week is estate administration. So Pete, we can come back to this at the end if you want, or you can say more about it here.
Well, one of the things that we established in the program is to make it a safe environment to learn about this. So none of the presenters will get your contact information. So you will not be solicited by either the presenter or by the charities. Two is that we do not allow any for-profit sponsors, again, to try to figure out how to create a safe zone to learn some of this material. All the presenters, the attorneys, could probably lecture on each one of these topics alone. We didn't want to do that. We want to bring in different attorneys so you get an idea of what the legal world is all about. We also want to give you an idea how different attorneys charge for their services and what they specialize in. So we're going to go through and ask them, just like we will with Dawn, how they get paid and how they charge. We look forward to getting your feedback as to what you want to hear, because most of the lectures on estate planning happen in 1 hour. We're taking 6 weeks, 1.5 hours per week. So we want to get into and educate you on this topic. And it's not about death planning. It's about incapacity planning, and we'll get more into that as we go through. Don, what is this on the screen?
So what I did was, having gone through all of these for numerous times, thought let's have an overarching document, if you will. So there is an estate planning workbook, which is in that same location I was showing how to download different things. This is there, and basically it's a narrative that covers over all 6 of the weeks. So it follows the same agenda you just saw, and that's where those come from. And we just felt that it was an idea how to get things started. And basically it's sort of, why do we do this? Spoiler alert, none of us get out of this thing alive. And as Pete said,
you mean we're all going to die?
I think we're all going to die at some point in time. And what condition you're in is a whole different thing, because then my term is sort of, so what happens to your stuff at that point? You forget you, what happens to your stuff? The other issue, however, and it goes to what Pete was just saying, is incapacitation. Some of us, or perhaps many of us, are or will become less capable. I'm less capable. Who's going to take care of us then? Whether it's us or whether it's someone else in terms of our money. And last thing is, wouldn't it be better to make the choices yourself? It's your estate, it's your life, rather than having others do it, because it is your estate. And if you don't tell someone else, then this isn't going to go well, because no one's going to know what you're talking about. So at this point, Pete, I'm going to bring us back to us. If you would like, I can share the screen with my Ask First form, or do you want to talk about something else?
No.
Please do. Okay.
Yeah.
Let me see if I can find that one.
This is our first session on the It's Your Estate. So I'm going to spend a little bit more time on this Ask First form than I will with the other presenters. Again, most times when I talk to people of why they hired the professional, it's because there was a referral from another person who didn't know anything more than they did, and the person is very, very nice. Well, there's some basic questions that you need to know. One is, what kind of education do you have? Don, what's your education?
I happen to have a master's degree in an MBA with an emphasis in international business, and a bachelor's degree in, I'm a real nerd, accounting and statistics, which is a really sad statement about myself, which probably then led to the fact that I've been a CPA for the last 30 years and more, and still continue, even though I'm retired and not actively doing these things. I still keep my license active because it means I get educated and follow what's going on in the industry. So,
well, you on the front of your outline, you call yourself a philanthropic advisor. What does that mean?
You suckered me into it. No. What it means is that Pete and I actually we were driving to visit a friend, and I made a comment of having an office building that we owned, and we wanted to sell it in capital gains tax and all this stuff. And Pete said, "Why don't you look into doing a charitable remainder trust?" And so I said, "What is it?" And so I started studying it. There's a company called Crescendo, which does all the software, and if you ever see the charitable giving module, you'll see that one. In terms of what all is there, and got certified by them to run their software, and really became very interested in helping people give to charity, which then Pete had asked, would I please come in and be the philanthropic advisor for financial and estate literacy and help them in terms of what's going on and looking at these things. So that's how I wound up being involved with that.
Yeah. And so one of your credentials is the philanthropic advisors. Yes. And I hope you put that on here next time.
Good point. Yes, I got that note from you just now, Pete. So, yeah, okay.
Relevant licenses. You're a CPA.
Yes.
And let's say Don also was an attorney and licensed in the state of California as a legal counsel, and he was licensed as a securities person.
That would be a conflict of interest in my mind.
Yeah,
certainly
a lot
as
of
we
people,
go through.
Yeah, a lot of people would think that, gosh, you're really qualified. In today's world, when you stretch beyond what you're licensed for, it is an area that you probably don't know as much. And it's time to start asking some questions why are you licensed in all these different areas?
Right.
You know, so licenses are different than credentials. We all have driver's license. That does not make us expert drivers. Okay, it's the entryway. If I were to look at this, I would say for Don, his 30 years experience is much more valuable than the CPA.
And as an example, in the case of being a CPA, my CPA is I'm a certified public accountant. Some people say a certified pain in the ass. That's a different story. So that is, in fact, a certification. That doesn't mean I can do anything. I have to then be licensed by the state of California or whatever state I'm in, which is why I have a California license number in here, which then says, yes, I can continue to practice. I have to keep my education up in order to keep my license current. So I have a certificate for a CPA and I have a license for being a CPA in this case. And it also, incidentally, is very important. If I was a lawyer, because Pete likes to say all the attorneys who do this, and yet I'm an accountant, Pete, you're an attorney, I'm not. That license number, you can go to the state and find out, does Don have any, bad things that he's done because you know my license number. And attorneys are exactly the same way. Brokers or other people, and we'll get into that in other sessions. But you can always go through, and that's why I put the license number here, because it's important if someone wants to look it up. There it is. Hey, here it is. I don't think
before you ever hire a professional, you should check with that association and their license number, because to see whether or not they have on the securities end disclosures, on the professional end, ethical lapses, complaints, all of those get registered by the state under their license.
Yes.
So, and by the way, although CPAs are the most trusted advisor there is in the country, they do disbar on a monthly basis many CPAs. So not everybody is a saint who's a CPA.
Or attorneys who are attorneys, yes.
Exactly.
On both sides of this thing. So anyway.
You do not practice law. That's a good thing.
I do not practice law.
And this is really important. He checks true that in the business relationship, he will always put your interest first versus his own or that of his employer. Most individuals would not state true, but that's really important. And by the way, Don, how are you paid?
I'm an odd person. I was at a symposium last night, and there was a guy, what's his name? Ken Blanchard was speaking, and he kept saying, people who are ducks, you got the quack, 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 quack. So I, think of some of these things in terms of looking at a duck. That's an odd duck question here. I'm a little odd because I don't want to be paid. But I discovered a while back that if you don't get paid, people don't think that you've given them value. So what I do is to say, I will charge you $125 an hour after a while. I don't do it in the beginning, but I will charge, if you really say do a tremendous amount for me, I will charge you. And what I'm going to tell you to do is to write a check to a nonprofit. I don't want the money because I don't need the money in my situation. And I don't want the tax implications of having that occur. Therefore, give it to a nonprofit. Whatever nonprofit you want. And if you can't think of one, you can give it to Financial and State Literacy, which happens to be a 501c3, and would be happy to take the money from you. So that's a place where, in fact, that is an option in terms of doing it. But that's the way in which I've chosen to operate what I do.
And then, so one of the things that we do is that we're going to check with every single person who's presenting, and we're going to ask them, how are you paid? It's one of the most important questions. Are you paid on an hourly basis? Are you paid on a retainer basis? Do you charge for phone calls, emails? Is there one set package price? You've got to talk to an attorney up front as to how you're going to be charged. And it used to be where tax issues was the major focus of estate plans. Today, that isn't the case, and we'll show you why a little later. But today, it's about your family situation. So besides the fact that you're going in for an estate plan, you have to really feel comfortable with the individual who does your estate plan, because you got to talk about your family, whether or not you have a child who has drug abuse problems or mental issues, or how you and your spouse get along, whether or not you're in your second or third marriage, et cetera, et cetera. So you got to be comfortable. The next question on here says, are you associated with anyone who sells? And of course, Don says no. But again, if that was true, you would want to know that up front. He certifies under penalty of perjury, which actually has a lot of meaning. If you take this thing to the court and you find out one of these things is false, this little paper right here, how long did it take you to complete?
It's probably like five minutes to figure out what all you put in.
Exactly.
It's more interesting to try to figure out how to line up all these things.
Yeah.
But
So
that's
it's called the Ask First form,
yes.
And a blank one is on the website. If you're going to talk to anyone about your money, we suggest that you ask them to complete this first, and in 5 minutes later, you'll have you'll know more about them than what you did before. Don, let's get into the presentation.
So what I'm going to do is I'm going to switch to a different presentation, and let's see how that comes up. I'm going to guess that came up. Okay, there you go. All right, I started watching. I'm watching. This screen does this screen does that, and that one is one of the participants like you who's saying, here's what's going on. So this is, I do, all those college education, all these experiences, and I do these sophisticated graphics. Basically, just to cover a really simple point, an advanced healthcare directive, which we will talk about next week in great detail, covers you from today forward. And my thing is today, tomorrow, and then is after you've died. Okay, so just didn't want to play dead in here. That looks bad on a graphic. And advanced healthcare directive covers from when you are incapacitated until slightly after death. And the part after death, incidentally, is an advanced healthcare directive can include your burial requests. So whatever you have, that can still be done by the advanced healthcare directive. The power of attorney for finance starts incapacitation and goes until you die. Interestingly, you can't spend money after you've died. Your estate can spend money, but you can't spend money after you've died. A will basically starts, other than some things that may be covered earlier, when you die, it goes forward. It really doesn't do anything other than I'd like so-and-so to watch my kids or something, a nice documentation, but it really isn't used until after you die. A trust is a contract that holds things, a living trust holds these assets or something like that. Starts today, runs while you're fully capacitated, and if you become incapacitated, we'll say, here are the things I also want to do, and then administers your estate after death. So that's sort of the continuum as we go through this, and why some of these things are very much interrelated as to what's going on.
Yeah, and all these documents, the advanced healthcare directive, the power of attorney, the will, and the trust, is all to give another person legal authority. And you should have legal authority in quotes.
Right.
That's what these documents do. And so there are going to be a lot of other people involved because you're giving them legal authority. And,
yes.
And these documents will will also state when you're going to give them legal authority and under what circumstances you're going to give them legal authority.
Right.
And it's in your total control.
Right, right. And certainly in the case of an advanced healthcare directive or a power of attorney, you can change those, cancel them, do whatever you want, whatever you want. A will, you can change whatever you want. A trust generally is a revocable trust, and a living trust is, and you can revoke it. I mean, we have a trust, and I think it's been redone 4 times. The name stays the same. They just take out the words and put new ones in, so you don't have to retitle the house again into a new name. It just replaces what was there, and something else comes in. Fully able to do that as long as we're alive, as long as we're capable. So,
and that's the key point that you just mentioned, Don. It's long as you're capable.
Yes.
So we really encourage you, if you're having By the way, the vast majority of people do not have an estate plan. And we'll talk more after in the second session about that. But the vast majority of us do not have an estate plan.
And I'm going to make the statement, I'm going to disagree with Pete. Everyone has an estate plan. It's either your choice or the governor's choice, because that's called intestate. And if you don't have it, then the government's going to decide and the courts are going to decide. And that probably is not where you want to go. So everyone has one, but everyone does not have one that they've written down and made it their choice. They have, think Britney Spears, think the governor of California, think the court system. Everyone has one, just not your control.
Yeah.
So on those lovely notes, we could move on.
Yeah. And this is all about planning for incapacity.
Yes.
That's where I want you to focus on.
Yes.
Next slide.
So that's what we will do over the next few weeks. However, the thing we want to do before that is we want to talk about taxes. We want to talk about changes in taxes, and then we can come back to other things at the end, but we want to really go through this. And this one is what, 4 days late? If you worked your tail off on Tuesday to finish off your taxes, you didn't have to do it, because given the floods we've had in California, the IRS said, you know what, we should give you a respite. You really have until October 16th to file. And this is delayed. I understand that, but I want to just go through it for a reason. So that's what they said. The governor then said, we agree with you. So unless you're in one of these 5 counties that don't affect anyone down here, you didn't actually have to file until October the 16th.
You don't even have to make your quarterly payments.
And I was going to come to that, Pete. Thank you very much for covering it for me. The thing that, number one, you didn't have to apply for an extension. It was automatically done for you effectively. You did not have to pay the money you owe the state for last year until October the 16th. As Pete just jumped in and said, you don't have to make your quarterly payments if you do those until October 16th. I have a very strong suggestion for you, however. You can pay it if you wish. Oh, and incidentally, if you're due a refund, file.
Yeah.
That doesn't require you to delay. You can file and get in queue for getting your money back. But if you owe money, you can wait until the end. We talked to someone on Monday or Tuesday, I forget which, and she thought you can wait to file, but you should pay. So she paid, but didn't file. It's like, that's going to really confuse somebody. That's the opposite of where we're going. I suggest strongly that since you don't have to pay all this stuff, put the money in a separate bank account so you don't go spend all the money. And then on October 16th, you're going to know, oh, whatever you had from 22, plus the quarterly payments that you've missed are all going to have to be paid October 16th, which is going to be a really ugly day from a banking standpoint. But that's where we are in terms of what's going on for this year. So let's talk about what the changes are, what the current level is. So this is the federal tax rates for, and I just made this simple in my particular case and said, married, filing jointly, and surviving spouse. Obviously, if you are single, it's separate, different. If you're married, filing separately, it's different. If you're head of household, it's different. But I just wanted to be able to talk about what some of these things mean as they go through it, because there's a lot of terms that we use, and I want to make sure that we're covering that and understanding where we're going. So if, as an example, in this example, if you had $50,000 in taxable income, your tax would be $5,560. How did we get there? Well, first 22,000, right? Whoops, hang on, let me click here. First 22,000, you would owe $2,200 on that. Then everything over it is 12%. So in this case, 50,000, so 22,000, then 28's left, 50 minus the 22. Is it 12% right here? That's $3,300. So your total tax is $5,600. That is your effective tax rate. So part of this was taxed at 10%, part of it was taxed at 12%. So the effective rate is 12.12%, which is 5,560 divided by 50,000. Okay. So that's your effective tax rate at that moment in time. Now, as another example.
Before you move on, Don,
okay.
I have a question for you.
Yes, sir.
What's the difference between the effective tax rate and no marginal tax rate.
No, Pete, I don't want to discuss that yet. I want to discuss that in a couple of moments.
Okay.
And we have a slide that will tell us that, Pete.
Okay, thank you.
We never get together and do these things, folks. So we're sort of, going along as we do this.
Well, there's so many, this whole class is about terminology.
Yes, it is. And that's why I'm going through this thing you could say, well, no, I need all the other tax rates, but then I can't do these examples. And I think the examples are critically important to people because of what they think is going to happen. So I'm going to use another example. If your taxable income was $200,000, first of all, congratulations. Secondly, you would owe $34,800 in federal tax. Incidentally, California, the tax rate is 1% to 13.3% is the max, and it stair steps up through it. So smaller numbers than these, but they're not insignificant when you get higher. So in this case, the tax, $190,000 would have been $32,000 plus the difference, which is $9,000. So 2,000 minus 200,000 minus 190,000 is this. That would owe another this much. Total is 34,800. So again, the effective rate is 17%. Right now, you're at 24 in here. This we'll get to Pete's point in a moment. But part of this was taxed at 10%, part at 12, part at 22, part at 24, and the effective rate is 19.4%.
17.
17.4%. If I could read, I would be far better off. So the important part of all of this becomes the marginal tax rate where Pete was going. What would happen if I earned one more dollar? One more dollar at 200,000 is 24% tax. So for each additional dollar, you would have to pay another 24 cents in tax. The effective rate is 17.4. So it's important to know which one of these am I looking at when you need to make a decision. If I took out my required minimum distribution and took it in, that's taxable income, and I would owe 24 cents unless it kicked me into another bracket. I'd owe 24 cents on that every dollar I got. But effectively, it may not add up to that much. The effective rate will start rising if you start adding marginal in. But that's the difference between these two numbers.
Yeah. So I use it for practicality purposes.
Yes. Yeah.
I usually make my donations, charitable donations in December, November, December. And I get together with the CPA and ask, what is going to be my RMD, required minimum distribution?
Right.
And then I ask about what is my tax rate? And then I also check on what's my Medicare rate and what's my Social Security rate.
Right.
And it just frustrates the hell out of me that I have to go through all of this to figure out what is the best strategy or how much is it actually going to cost me to make a donation out of my retirement account. And what I found is that I win almost every time giving money to charity out of my IRA account.
Yeah, and that's where it's an important point of this. This is the marginal rate that we have here, but that's only federal tax. It's not state tax. And as Pete said, it's not the fact that your Medicare bill went up because you crossed into another level. And that one, when you cross the level, you pay that amount now. And it doesn't take into account any of these other factors as you go along. And so now how much you pay, how much you're taxed on your Social Security. The higher your income, the higher percentage they tax. Up to a maximum of 85% of it is taxable as ordinary income. At a lower income, it's a lower percentage that's taxable.
And Medicare looks at your returns from 2 years ago.
Yes, yes.
So it's not like from last year or the year before. So it behooves you to be somewhat tax wise, especially as you get up in the income area. So these are really important things to know about your own state. If you're lower and you're in the, under 100,000, be thankful in the sense that things are much more simple.
Yes, yes. Okay, so with that all in mind, let me go one further. tax consideration, somewhat to what Pete was just saying. So as you get over, and it's changed as it's gone along, it was 70 and a half, it went to 72, it went to 70, it's going to 73, and then it's going to 75 over the next few years. There's stair stepping up the number. Once you hit that point, you have to take out a required minimum distribution out of an IRA account or a 401k. Does not affect Roth accounts, as you see here. And the reason the difference between these is when you put money into an IRA or a 401k, you use pre-tax dollars. So if you were earning $50,000 and you put $5,000 into an IRA, you were only taxed at $45,000. Well, gee whiz, the IRS would like to have your money back, their money back that you've been holding from them. So they're going to tax it as normal taxable income. Well, wait, I thought your capital gains thing was over 12 months. I've had this account for 15 years. Yeah, well, congratulations. It's coming out as normal income. And so that's an issue that you're going to run into. We'll talk a little bit now and more in the charitable module in week 5, 4, 5, I forget which week, 5, I think, on a qualified charitable distribution. And let me just briefly mention it here. If you tend to give to charity during the year or at the end of the year, as Pete was talking about a moment ago, and you are having a required minimum distribution, seriously consider having the money come directly out of your IRA or 401, out of your IRA, and go to a qualified charitable distribution. Pay a charity, tell whoever it is you're managing your account, write the check to Finance and Estate Literacy, to the Heart Association, to Mary's Path, any of those. Get that check mailed to you, make a photocopy of it, and mail it to the charity with a note that said, Pete's giving money to you, so that he can get the attaboy for it. It reduces your income. It doesn't matter if you are using a standard deduction. Normally, charitable giving requires itemized deductions. In this case, your income goes down. So it's 100% deductible because the income is removed. If, for instance, you had a $15,000 required minimum distribution and you put 5 of it to charity, you're only taxed on 10. If you take the money as required minimum distribution, let's say you only had a 20% tax rate overall. You'd have to pay that $5,000 out, you're going to have to get $6,000 out of it. Pay the tax and now pay 5. Save the money. Do a QCD. And incidentally, your Medicare bill may go down. And your percentage of Social Security charge may go down. So it's a win-win all around. Roth IRAs are not taxable when they come out because you use post-tax, after-tax money going in, you can take it back out again. And as it says, Social Security is taxed at some level, but it depends on your overall income as you go along.
So one of the things that we're going to be doing, we have an excellent presenter in the name of Michael Simon. Mm-hmm. And Michael is going to go through the entire retirement planning area. It's probably in most individuals' estates now kind of the second largest asset beside
after your house. Yeah,
after your home. And we'll go into this detail. The philosophy of financial and estate literacy is that you have to take care of number one, and that is you first. That's the most important. If you don't take care of yourself, you can't depend on somebody else to take care of you. 2 is, once you're taken care of, make sure your family is taken care of. Okay. Once your family is taken care of, then the third consideration is you may want to consider a charitable organization, and definitely you want to consider a charitable organization before you consider taxes. And we want you to do that tax wise. It does not cost $1 to give $1. And we'll go through that in the charitable area. And a lot of times, sometimes charitable areas helps you, helps the family, and reduces your taxes. So we'll get into that a little bit more on a later end. What's the next slide, Don?
The next slide is on the standard deduction. And again, I'm using only the married filing jointly, and there are other ones for all the other groups. The important part of this is, so at the present time, there's a $27,700 standard deduction. You don't have to explain anything to anybody. You can just say, here's my income, here's my standard deduction, and some other things involved. Here's my taxable income. The importance of this is you can do instead itemized deductions. But if your itemized deductions don't add up to 27,700, don't do it because it ain't going to help you. So normally, if I write a check to a charity, that may be an item, part of my itemized deductions. But if I don't have enough things in here, and a few years ago, we had the unique opportunity to have SALT, state and local taxes. We're limited to $10,000 now. It used to be you could take all of your property tax, all of your tax you had in California, all these other things, and probably exceed 10,000, especially if you live here in Orange County. But now they're capped presently at $10,000. So it's harder now to get up to this 27,700. And that's why I think it's something like 85% of the people who file returns just use a standard deduction. Why is that important? Here's why it's important. Because in our prior example where we had 50,000 in taxable income, you could have earned 77,700, but then you took a standard deduction of 27,700 and you got back down to 50. So that's the difference in here is that reduces nicely what your taxes, what the taxes are that you will owe. But that's a very important one when you consider against your itemized deductions versus what a standard is.
Yeah. By the way, most individuals will, well, not even most, every individual that I've ever talked to about taxes feel that they pay too much. My mother paid $1,000 a year in federal income taxes, and she thought that was absolutely outrageous.
Right.
So
yeah.
we all
They're stealing
that,
from you.
Yeah, we all believe we're paying too much. So no matter what the amount is, but you really need to understand what is your taxable income after your standard deduction, because you don't have to save those receipts that the clothes that you gave Goodwill or the Salvation Army. It is a total, you don't have to, if your mortgage payments are over $10,000 a year, you only get to adjust 10,000. So it's a different world today.
Right. And the other part of that is it also depends on what kind of income you had. So capital gains tax. Capital gains tax is a lower tax than normal income is. And we'll talk about what is what is long-term capital gains, because it really is long-term capital gains that makes this differentiation. The important part in going through this is the brackets are very different. So married filing jointly, it's $89,250 is zero tax. And you can look at it and go, wow, I can earn almost 90,000 and pay no tax. No. And the reason is this. The rate depends, first of all, long-term capital gains means you've owned it for 12 months and when you sell it. Long-term capital gains, however, is your total income against that, not just your capital gains. So for instance, if I was looking at this, it isn't 89,000 of capital gains. It's 89,000 of your total income. So if you had only capital gains and it was $85,000 a year and that's all you got, you'd pay no tax. But if you have normal income, which generally people have something, Social Security as an example, then if you cross over that 89,000 in total, so what happens is they put in the money that you earned in capital gains, figure out what your total amount is, subtract out capital gains, tax it at this rate that you see on the screen, and then tax the rest of it as ordinary income. This lovely convoluted process that they go through, but that's what this whole thing's all about. So it depends on where you are and what's happening. The other thing, and it's more of an issue on the financial, it's your money side than it is, we don't talk about it as much in It's Your Estate, this seminar, is if you buy into a mutual fund or something else, and they're churning the account, you're getting ordinary income out of it. If they buy and hold, whenever there's a distribution, it would be long-term. And it's very important to know where your investments are and where these things fit in terms of what's going on.
Yeah. You want long-term kind of long-term capital gains, income, and qualified dividends as income, because the maximum is 15 to 20%, whereas ordinary income, the maximum is 37%.
Right.
That's
and you got to go way up. Yeah.
Yeah. Right. Huge difference. So
and the other thing is whether you want non-taxable, you know, on a a municipal bonds or something else, where are those accounts being held? What are they doing? And what's the after-tax effect? You may earn less, but it's tax-free. But if you look at the tax, how does that fit into your tax? As Pete was saying, your marginal, your effective tax rates versus what was going on with a non-taxable.
Let's go to the next slide.
Let's go to the next one, Pete. Let's talk about death and taxes. So first issue in here is annual gift tax annual exclusion.
What does that mean?
What does that mean, Pete? What that means is you can write a check to anybody you want for up to $17,000. Give them the check and tell no one.
Including the IRS?
And you give them the check for 17. I wouldn't give them.
No,
the check
I
for
mean,
17.
you have to tell the IRS?
No. And when that person receives that check, it's not income, it's a gift. So they can take it down and cash the check, whatever they want to do, and have the money and not tell anybody about it.
No one.
So no one, not a thing. $17,000 this year, it's 17,000. And that's you as an individual. And I'll show you an example in a minute about that. Then you have estate gift and generation skipping tax. The exclusion currently is $12,920,000. Probably most of us aren't going to exceed that. And that's per individual. So as a married couple, it really is $25 million, which probably even less of us are going to have a tax problem with that. So I'm not sure I even care about that. Yeah, you will in a minute, and we'll talk about why. We'll skip over the exclusion for non-citizens because we don't know any of those people, do we, Pete?
No, we don't.
Okay, fine. It's a long story, people. We won't go there. The other is if you accidentally got over $25 million in estate, you would owe tax up to 40%. It steps up, but the maximum estate tax is 40%. That's high. There's an awful lot of planning, and know incidentally that nationwide, I think last year or the year before, there were only like 1,000 estate returns that paid tax because this is such a high limit that people don't really care a lot about it.
And there are so many techniques to avoid having to pay that 40%. So it's almost a volunteer tax. If you do nothing, then you would pay that 40%.
Yes. I'm sorry, I was looking at something. Let me click here so I can get. Why are you not letting me click? Let's see if I can do this. Okay, there you go. At the moment, I'm just going to summarize to these two because I want to put this up. One of the things that's very important for us is I made the comment about the $17,000. That is per person writing the check, me, per person that I write the check to. So as an example, and I don't have to tell the IRS any of this. My wife and I have 2 daughters. We have 2 son-in-laws. We have 4 granddaughters. I could write a check to each of them, and the 7-year-old would love a check for $17,000. That would be entertaining. That's $136,000 that I can give away out of my estate and tell no one other than the giggling 6-7-year-old. 17-year-old would probably be different at her age, but the youngest one, that'd be interesting. But I can give away $136,000. My wife can write the exact same checks, but her signature on them. So we can give over $250,000 a year without telling anybody. And that's only our family. You could write a check for $17,000 to Pete, and he wouldn't have to tell anybody either. He'd just keep the money. So all of that is very important for you to be aware of. The other thing, however, is you actually have the ability to give more than $17,000 to anybody you want. So if your kids say, hey, would you help me buy a house? I need X amount of money over 17 that is for a down payment or whatever it happens to be. You can give them the money, no problem. If it exceeds 17,000, legally, you have to tell the IRS on a Form 709, which is a gift tax return. You can give them $12,900,000.
You mean 12 million?
I'm sorry, 12 million. You have that too. 12,900,000. Leave the 20,000 in here. You can give all of that away. You would file a 709, and what it means is when you die, you have no exemption. Everything you have then is taxable. but you can give it all away while you're alive if you wish to. You
And pay
just
zero tax.
You just legally have to tell the IRS you're doing it. You don't pay any tax. The recipients don't pay any tax. So it's out there, but you don't actually have to, you won't have an exemption when you go. Let me give you an example. Our children, we chose to do something with our corporation. We gave that to them, and for the sake of discussion, it was valued at $2 million. When we did, I filed a 709. So today, if I die, I only have a $10,920,000 exemption because I've used two. Now, all of this is legally you have to. I'm not going to tell you what you have to do politically or nicely or whatever else. If the IRS found out you gave it away and didn't tell them, they'd be really pissy about it. But I told them in a 709, I gave my children $2 million. They paid no tax. I paid no tax. They said, thank you, Dad, very nicely. So you have the ability to give more. That's not a problem. You just have to deal with it in some way by telling the IRS.
And that goes for gifts as well. Let's say you give
That is a gift. It was a gift to them.
No, I mean, I have a physical gift. Let's say you owned a painting, Don, and it was appraised for 17,000, and you wanted to give it to one of your kids. So you wouldn't have to file any kind of gift tax return. By the way, very gift tax returns, most people don't file them. Don was being very nice that said, because people aren't aware, unless you're Donald Trump, who never filed a gift tax return and never got penalized either. So
we'll skip that part, Pete. Yeah.
Yeah. But people believe that they have to pay a tax if they give something of value over 17,000. And that's not the case. So if you give your child to help them with a home, whatever, you're supposed to inform the IRS, but many people don't.
So one of the things, incidentally, there was a question that had just come up. The $17,000 gift is an annual exclusion. Every year you could give that 17. Now, the 17 number changes. I think last year it was 15 or 16.
16.
So it changes. It's been growing over time, probably some inflation thing or something else in it. So that changes every year as the exclusion. In 23, you're allowed to give 17,000, and that is an annual exclusion. The 12,920,000 is a lifetime exclusion currently. So that's a really important one to split out. And the value of the gift that you're giving is the value that it has when they receive it. If you gave your children stock or something like that at less than 17,000, their value at that point, if they went to sell it, would be your basis on it.
Well, do you have a slide on cost basis, or we're going to talk about that now?
We can talk about it now.
Okay. There's a term of art that says cost basis in accounting. And what does the cost basis mean?
What did you pay for it?
Let's say I bought
No. That's the answer.
Okay.
What did you pay for it? That is the answer.
$10.
So if you bought that Apple stock for $10 a very long time ago, and it's now worth 1,000, it's making up numbers. Your cost basis was $10. If it becomes 100 or 1,000 or whatever it is, then that is the market value of it, and the difference between them is capital gains. Now, if I gave you a gift, you maintain my basis. So what I paid for it, the $10, which means if you then said, oh, thank you for the $1,000 thing, I'm going to sell it, you'd have capital gains of $990 reporting on it. Now, that's someone who have to trace through all of that stuff to figure it out. And if it was a gift, you'd probably just stay quiet and not talk about it. But I'm not going to say that on camera.
Yeah. So one of the questions that we got is there any benefit to a person who's making the gift from a tax point of view? And it used to be that when the estate and gift tax transfer amount was a lot lower, let's say it was at one time $1 million, and it was one time 600,000, and in 1 year,
2010, it was zero.
Yeah, 2010, you could give away your entire estate,
right,
and pay absolutely zero. in estate and gift taxes, or the exclusion was zero. Many times in those particular circumstances, if somebody was seriously ill and they knew they were going to die and they wanted to lower their estate value, then they started making gifts to the children. So that's about the only real benefit there is, besides the fact of feeling good that you could help your kids. So,
well, the other one, and the reason where that does in fact extend a bit, is know that in 2025,
yes,
this 12,000,009 drops potentially to 5 million. Now you may still say, 5 million each, 10 million. I'm still good. Okay, that's wonderful. Congratulations on having a small estate in the relative terms. But in the area in which we live, there's an awful lot of people that just triggered a problem. So the issue becomes now giving the gift, writing a check, whatever it happens to be, would then possibly avoid estate taxes because you're underneath that level.
Yeah. So if you have an estate that's maybe 10 million, then you may want to be kind of concerned with the 2025 issue,
yes,
because it sunsets and it
yes,
will be reduced to 5 to 6 million automatically. Now,
right,
whether Congress, what that means is Congress would have to pass a new bill, a new law for the exemption to make it different than
right,
5 to 6 million.
right, correct.
Nobody knows whether or not that'll happen.
So,
Don is of the opinion, I think, that will be reduced to 5 to 6 million if he had to guess.
Well,
if he had to guess.
I'm sorry. I say yes, I think it will, because I don't know how Congress gets around to doing anything, frankly.
Yeah.
I'm sorry, that was a political statement, but there's so much going on.
I think it'll stay at the exclusion level, just because I think
if Bernie Sanders has his way, it goes to zero.
So there you go. But most senators and congressmen are in the $10 million.
Yeah, they're going to, for themselves and their constituents, they're going to say, no, it has to be higher than the 5.
Yeah.
But here's the other side of that. And I want to point out the last line on this slide: request portability. This is something that, again, my CPA, I'm required to keep taking courses. And one of them was on estate taxes and whatnot. And they said a series of attorneys and accountants talking about what are the primary issues you see. And the number one issue they all said was this odd thing called portability. Portability is, so if I die today and Jean gets everything, so I'm using, so
Jean
she would
is your
use,
wife.
I'm sorry, Jean's my wife. Jean would get everything, and therefore there's none of my 10,000,009 used because a spouse has unlimited, so she gets all of it. Jean should request portability to take my unused portion of my exemption. Now, somebody had to die to do this. I understand that. That came up the other day. Who had to die? Oh, whoever it is you're trying to have portability. Whatever is left of their exemption, you file a 706, which is a estate tax return, and request portability. What that says is Don died, and there's, I don't care, $10 million left in his exemption. Jean then takes that portability, and if in 2025 it all drops to 5 million, hers will drop to 5. Mine stays at 10.
So she would have a total of
15.
Somewhere around $15 million exclusion.
If you don't request portability, it goes away.
Yeah.
So then she'd be left at 5, and mine would be lost. Portability, it used to be, the IRS is very smart in the things they do in some things. This one, when people died, people would request portability. And in the first year after death, no problem, automatically done. Then they started charging a fee if you went over a year. And they generally would approve them up to maybe like 5 years out. But they got paid to do that. Then the IRS said, well, this is a nuisance. Why are we doing this? Why don't we just let them select that for free for 5 years? So they're now not charging anymore. But if someone in your family died in the last 5 years, talk to your accountant and file a 706. They're a complicated form, but apparently now the IRS is allowing you to fill out the section only on portability. So you'd have to figure out what was left. That's work. And you may have to pay a fee and maybe, $5,000. I don't know what the number is, depending on how complicated it is. But it means you will hold that money. And the IRS has said their term, we will not claw back the value, and say, no, Don would have been really at 5 million minus the 2. He only has 3. It's back up here at the high level. And with the potential big drop, you might want to request portability on these things. And that was the number one issue that they said was a problem for people. So think about portability.
Yes.
One of those really interesting things to discuss at lunch. I don't know. Anyway, the next issue is step-up basis. Today, when you pass away, the assets you hold are going to can up value, step-up basis, to the current market value. As an example, you own your home as a community property with your spouse or designated domestic partner, whatever the term is these days. When you pass away, so if your basis was $500,000 and now it's 750 or 5 million, depending on when you bought the thing, the value will jump up to the new level, which means if it was sold today, there would be no capital gains. Where if it was down at that low value, there would have been a big charge for capital gains, which is why Pete would say to you, don't give the property to your children while you're still alive, because they take your basis. Wait until you die, give it to them as part of your estate, and now it's up here at the higher level.
In fact, I'm going to interrupt you just for a
second, please. No, I'd like you to.
For all of us, what we need to do is get a yellow sheet of paper and list all your assets. Mm-hmm. And then right next to that asset, list how you have title. Because as you can see in the slide here, it affects taxes, whether or not you have a title as community property with right of survivorship, or you have it in our living trust, or if you have it as joint tenancy, or if you have it in tenancy in common. Title is really important.
Yes.
So you named a title. The third thing you want to know is what is the cost basis? So the cost basis, like what Don said, what you paid for it, unless you own rental property, because you depreciated that every year.
Right.
So you need to understand your cost basis. And then right after that, what you need to know is market value. Okay. So, and it's all the issues that you have here. Let's say I have a stock that I purchased, Apple stock that I mentioned, and I bought it for $10. And I give it to my son, 1,000 shares. What happens when he sells that stock during my lifetime?
It's $10 is what he paid, what his basis is. So he would have capital gains on all of it.
Yeah. And if I gave it to him through my trust after my death and he sold it, would he pay any tax on that at all?
No.
No, none.
Now,
because of that step up in basis.
Because of step up in basis. Now, with step up in basis, if you own that property in joint tenancy, then only half the value goes up, not 100%. And that's really critical. And that's why Pete has a minor fixation about titling, because it's critical in terms of how things go up and move and what occurs with it. Now, Pete's stock that he talked about in his example, he's absolutely correct. Unless that was in his retirement account.
Yes.
That doesn't step up in basis.
No step up in basis on retirement accounts. 401ks, 403bs.
That's ordinary income when it comes out, regardless of what you've done and how long you've had it. It doesn't matter at all. And that is why this is and what Pete's point is an outstanding one in terms of what do you own? What's its name? When did you buy it? How do you own it? What's your cost basis? And what on the other side? Now, part of the reason that this is the way it is on the step-up basis for federal is that years ago, I think it was in the Bush administration, they tried to say, no step up, we're going to go to original value, original cost. And the IRS came back to them and said, we can't do that. We can't figure it out. Because when, as an example, when my father was very ill, he gave me a box one day, a file box. And I opened it up and it had their house in Manhattan Beach, the one they moved to in Palos Verdes, the one they moved to in Fullerton, the one they moved to in Laguna Beach. Now that started in 1941 and went up to 1970 when they, 73, when they moved into the house in Laguna. And it was the payments and the upgrades of the area. This was his history of all of his home, because to him, the house in Laguna would be valued at the house in Manhattan Beach. Now, my father was slightly retentive in terms of what he did, so he had all these files. The IRS went to the government and said, to the feds and said, we can't figure this out. People don't have this stuff. People aren't normal like my father, normally doing this. So there's no way of establishing the basis. Therefore, we should step it up to current. Somebody asked the other day, do I think this will ever change? I'm never going to say never, but I'm going to tell you, if the IRS objected, you're in a pretty safe basis with this one. That probably
more than likely, step up in basis is going to be around quite a while.
Now, yes,
you need to consider that when you're making gifts. Okay,
right.
They're, gifts of physical property, whether it's personal or real, the step up in basis does not apply. Whoever is the recipient gets the cost basis of the gift. California,
so hang on a minute though. So as an example, and the issue you face is, when my mother passed away, when my father was very ill, I talked to my sisters and said, you know, we all agreed I'm going to buy out the house in Laguna. So I bought the house from my father while he was alive. Vivrette Family Trust, his trust, sold it to Vivrette Family Trust, my trust, and we took the house. Now, as Pete just pointed out, my basis when I took it was the price he paid for the lot and to build the house. That's a bad thing if I plan to sell the property or the house. I plan to tear down the old house and build a new one, which we have, and live here until I die. In which case, I didn't care about what Pete just said. The important part is where Pete's going to next. The state of California at that time, this is all Prop 13 stuff in the beginning, parent-child transaction. The IRS said, state of California, Franchise Tax Board, said, no, a trust bought a trust property that didn't count. Legally it is because it passed through all this stuff. They gave me a tax bill for 8 times the amount my parents paid and said, this is how much you now owe. And I said, no, I owe theirs parent-child. But I needed a tax deduction that last year, so I went ahead and paid it. 6 months later, they mailed me back the money with interest and said, okay, you win. So our basis is very low on this particular house. Now, where Pete was going is the state of California, Prop 19, I think it was, or something like that, said, we're really mad at the people who own the property in Malibu. The actors who bought that property years ago built these incredible houses on the beach. And when it passes to their kids, they don't have any increase in property tax, and they rent the houses for $1 zillion. So they said, we're going to change the law. They did, and we approved it as a voters. So when your house now up values to its current value, California up values your property assessed value. That makes it a lot harder for your kids to keep the house, because one of them would have to say, that's my primary place of residence. And then you get, I think it's $1 million exemption. But if both of them say, no, we're just going to rent it out, property value is going to come up to current. And if there's a big increase, I mean, back in 20 years ago, it was 8 times the amount of tax. I have no clue what it would be today. So that's a change in the rules. And that went into effect, I think, February of last year or something like that. And it is not going to go away because California is loving the income. So that's the change, where it's step up federal, no problem capital gains. Problem, property tax. That's going to go up with you.
So in the estate and gift, in the estate planning area, you have your income taxes that you have to deal with from both gifting and also from IRAs and what they 401ks and the like.
Right.
Then you have the estate and gift tax issue that you need to be aware of. That could be a 12 or 5. Then you have property taxes issues here in California to be aware of.
Yeah.
So taxes are just a major part of estate planning. And the good news is that vast majority of us don't have to be concerned on the estate and gift tax
The
area
federal estate tax, and there's no estate tax in California, incidentally.
by constitutional law. So
By
the
constitutional law.
Constitution states that no inheritance taxes in California.
Right.
So it's a good
Other
place
states,
to die.
others, from a tax standpoint, that's absolutely correct. There may be some estate issues along the way. We won't bother to go there. That's a whole
Okay.
other story.
Right.
But it is very important to know, and these are all of these moving pieces as you go along. And so we'll talk about a lot of that in terms of, the advanced healthcare directives and the power of attorney, which is while you're living and a little bit after. But then it's the will, and then it's the trust, and how all these things are planned out, and what do you want to do? I was at a function last night, and I was talking to a 4th generation family that owns a bank and other businesses. And how do they manage this? But it was a generation skipping trust that owns all of these things. And it was interesting going through and talking to all these various, it's a small business, family-owned business meeting. And how do all these different groups handle these things and what else going on? But a lot of that comes back to these kinds of tax issues and what's going to happen. So those are the pieces.
We'd like to try something new.
Well, let me do one more thing. Let me do this one thing.
Okay.
Go here and just say, so next week, what we're going to do is advanced healthcare directives and power of attorney. And I want you to think about, who would you want to oversee things? Who would you ask? The classic always is, well, the oldest son has responsibility. Don't curse them with that. First of all, I'm the oldest son because I have 2 older sisters. I'm the only son. But it doesn't mean that they're the right person to have. Are they here? Do they understand this stuff? Who's the best person to handle it? And then think about those kinds of things while you're alive, and ultimately then after your estate, what's going to happen? So all of these things are really important and critical in terms of what's going on. So that's where we start next week and start really digging into this stuff. So now to Pete's case, I'm going to stop this and I'm going to end sharing, and it's going to be just Pete and I sitting here.
Or
So
Trevor, if you want to come in, you're more than welcome. Go ahead, John.
Trevor may have gone away. Does portability only work when it's a spouse and not when it goes to your children instead? The issue is the person who dies. It's their portability that they're requesting. And to be honest, I don't know the answer to this question. It's one that we can save and ask later. I always think of it going to a spouse. And so if you're the second to die, is there portability or not? I'm going to be honest with you, I don't know.
It has to be a spouse.
I was going to say, I'm assuming it has to be spouse. But that's, Pete's answered our question because he's the lawyer and I'm the accountant. So Pete got to answer that question. So, I didn't want to go there. I wanted
So
to
what we're going to try to do is we're going to try to bring you in, and if you want, you can turn on your video. Yes.
Stop.
Okay.
What I'm going to do first is I'm going to say, that's the general session that we have done. We're going to try something different, but we're going to turn off the camera in a moment. So what I want to do first is to say, thank you very much for attending this session. It's been the first session of It's Your Estate. Next week, we will go into advanced healthcare directives and power of attorneys for finance. Love having you here. Love the questions and the comments that you're making along the way. And that's very important to us. And again, there will be a video posted within X number of days or something like that. It should be there. I've been a good person this time and actually did turn on the recording. I just looked to make sure. I occasionally have forgotten them. That's been a problem. They're surprised they still let me do this. But anyway, that's where we are. And so I thank you very much for being here. And now I'm going to turn off the recording.